We are now going to start looking at our exempt income sections. So a lot of these are very simple, and you just need to be able to recognize it in an exam. They won't ask you to list them or something like that. So for example, Section 10.1G, Section 10.1G capital A and Section 10.1G capital B says that if you receive a war pension, awards for illness, diseases or death, it'll be exempt. So guys, how simple it'll be in an exam is they'll say to you, Mr. X is very old clearly, and Mr. X received a war pension of 100,000 rands. When you do this person's taxable income, you'll say war pension. A pension is an annuity, so it will be included, and then you'll apply the exemption, and just the full amount will be exempt in that manner. Right, as simple as that. Same for the awards for illness, death or disease. Amounts received from a social security system of another country. America is the best example of social security. So this will be if you used to work in America and then you move to South Africa. Now you're still receiving money from America because you, in terms of the social security system, you'll remember you're now a resident, so you'll be taxed on in South Africa, but it will be exempt. Local interest earned by non-residents. This is something that you'll study when you look at non-residents. UIF payments received. It will be included in your gross income, but it will be exempt then. This around Section 8C is something that you'll study more when you look at fringe benefits. I've just included it here. And then Section 10.1U, alimony and maintenance received if divorced after 21 March 1962. Now, remember, when we looked at special inclusions on the gross income, you would have seen that if you receive alimony, it's included in gross income. So this means if you were divorced after 21 March 1962 and you receive alimony, so your spouse gives you maintenance payments, it will be fully exempt. So this is the majority of people now. It's getting quite long ago, 1962.
Let's talk about the interest exemption, which is discussed under Section 10.1I. This is also quite often called the local interest exemption. So if you are a taxpayer and you receive local interest, you can claim an exemption for that. Now, important couple of things. First thing over here, who does it apply to, or what does the exemption apply to rather? It applies to interest from a local source. So for example, interest that you receive from a South African bank or a person in South Africa that pays you interest. So even if I potentially have a debtor, so let's say I sell goods to a person and I charge them interest on the outstanding amount, and that interest would also be local interest if the debtor is from a South African source. So important here, it does not apply to foreign interest. So if I earn interest from a foreign bank account, and it also does not apply to interest from a tax-free investment, which is discussed under Section 12 capital T, and that's something you'll study separately. Who can claim this exemption? So who's able to apply this? Only natural persons. So companies do not get an interest exemption. So if I'm a natural person and I receive interest from a South African source, I can claim the exemption. If I'm a company and I receive interest from a South African source, I cannot claim it. Right? Only natural persons, very important. Now, how much is this exemption? Now, this is the exemption rates changes every single year, or it can change every single year. Some years it's constant. And to get the latest rate, you need to refer to your tax legislation. And because you are still studying, you need to also look at whatever rates it is that your university requires you to use. Usually what your universities require you to use is the rates per the tax legislation, but please do be aware if they specifically tell you to use something different. They don't often do it, but they could. Now, important also, this exemption usually differs depending on your age. And again, this is something that the government can change as much as they want. Most of the time, there's, for example, a distinction between taxpayers who are 65 and older and taxpayers who are younger than 65, but they can change it at any point in time and say, all right, now let's also have a distinction for taxpayers who are 75 or older, or 85 and older, whatever the case might be, or taxpayers who are 30 years and older. They can do whatever they want. So be aware of this. Go and look at your psych legislation. I'm specifically not also mentioning it here because remember what I'm trying to teach to you is that you understand that there are principles involved. And as a chartered accountant and as someone who's going to, or a tax practitioner, someone who's going to be working in tax, you need to be aware that these things change all the time. So I don't want you to just study it all by heart. Refer to your tax legislation. One comment I would like to make is when they do split between ages, like they quite often do. So for example, taxpayers who are younger than 65 and taxpayers who are 65 or older. You might ask, what happens if a person is 64 years old, let's say, 64 years old, and they would turn 65 that year. So let's say they are 64 years old currently, 64 years old, and let's say their birthday is 15 December, let's say, for example, and they die on the 11th of November. So this person is 64 years old. They would turn 65 on the 15th of December, but they die on the 11th of November when they are still 64 years old. What exemption would they be able to claim? For a situation like that, important, you always look at the age that they would have been on the last day of the tax year. And remember, for natural persons, the last day of the tax year is the last day of February. So you would say this person would have been 65 years old if they had lived until the 28th of February, let's say. So therefore, you would apply the exemption which is applicable to a person who is 65 or older. Then, do you apportion this exemption? Now, remember, apportionment is something that you'll see quite often in tax. Apportionment means, for example, if you are saying, this is the exemption, and you apportion it for 6 over 12 months, or more accurately, something, for example, like 180 days over 365. Unless they specifically tell you in the Act to use days, you are welcome to use months. Days is just a bit more accurate. Right, and you'll see I often use days as well. Now, when do you do this apportionment? You only do this apportionment if a person's year of assessment is less than 12 months or less than 365 days. Now, what does that mean? A person's year of assessment is less than that period if they die, or if they are born, or if they immigrate to the country. So what do I mean by that? Let's say, for example, that here's the tax year. The tax year runs from the 1st of March until the 28th of February. And let's say on the 1st of June. All right, let's just put that date down. So just give me 1 second. Okay, so that's 92 days before June and 273 days after June. Right, is that period. Now, if a person is born here on the 1st of June, then their year of assessment is 273 days out of 365. Right, only from the date they are born. If a person dies on the 1st of June, then their tax year runs from the 1st of March until the 1st of June, so 92 over 365 days. That's how you would apportion it. If a person immigrates into South Africa, so immigrates, that means they become a resident, then their tax year is 273 out of 365 days. And by that same understanding, if they immigrate, exit, so if they leave the country, then their tax year is 92 over 365 days. Okay, be aware of it. That is the only times it happens. Now, what I want you to understand is, let's say that a person was a student and they started working for the first time on the 1st of June, their tax year is still 365 days. You don't say it's only from the period that they start working. Or, specifically with this interest exemption, let's say a person deposits money in the bank and plus starts earning interest from the 1st of June. their tax year is also still 365 days. You don't apportion it for times they earned money or they're employed or unemployed or anything like that. It's just death, birth, and immigration. Immigration has an effect on that as well.
Then we have local dividends. Most of us know this one. If you receive local dividends or dividends from South African companies, they are exempt in terms of section 10(1)(k). There are some local dividends which are not exempt. Guys, very rare to see, just included it here. The first one is, let's say, dividends that are declared by a real estate investment trust. Now, technically speaking, REITs will not be examined, but they have, for some reason, shown this in the ITC exam pronouncement, so I'm just mentioning it to you. So, real estate investment trust, I'll tell you it's a real estate investment trust. I'm not going to go into the detail of that. They'll state to you, if a real estate investment trust pays you dividends as a resident, it will not be exempt. But if they pay it to a non-resident, it will still be exempt. Right, again guys, like I said, not very common to see at all. At the bottom here, a special rule, which you'll see again throughout the year. Dividends received as an annuity are not exempt. So this will be if a company decides to pay dividends as an annuity. Remember, an annuity, most of the time we'll just state it, but an annuity is an annual payment that is repetitive, so it repeats itself, and there's an obligation to pay. So it might be that the company pays dividends every year, pays it into account, and then distributes it as an annuity, or it might be a pension fund that does that. If you receive dividends in the form of an annuity, so let's say that you receive 10,000 for the year as an annuity, your calculation will just be dividends, 10,000, section 10(1)(k). It's not applicable as it is an annuity, and that is per section 10(2). Right, so you'll be taxed on it.
Now let's look at the foreign dividends exemption under section 10(b). Now, when we are looking at this exemption, it's important to understand that this only applies to foreign dividends. So if you earn a dividend from a foreign company, not dividends from South African companies. So foreign dividends. Now, when we're looking at the foreign dividend exemption, it's important to note that there are two types of exemptions that you get. Section 10(b)(2) and its subparagraphs talks about 100% exemption, and section 10(b)(3) talks about a partial exemption. Now, you always first consider whether or not the 100% exemption applies, and only if it doesn't apply, so if it doesn't apply, then you look at section 10(b)(3). Now, before I talk about the details around it, what is the difference between a 100% exemption and a partial exemption? Let's say you get a foreign dividend of 100,000 rand, so you've translated it. If it is a section 10(b)(2) exemption that applies, the full amount will be exempt like that. So 100% exemption. If section 10(b)(3) applies, then you will apply some sort of fraction to it. So x over y is what I'm saying there, and I'll talk about that in a little bit. So let's just say, for example, I'm not saying this is it, but let's just say, for example, that that fraction over there is 8 over 28. So you'd say 100,000 times 8 over 28, and that would give you 28,571. So what I'm trying to show you is that you get 100,000, but the full amount is not exempt. So it's a partial exemption. Okay, so let's talk about that. So first up, you need to understand when it is 100% exemption. So please do go and look at section 10(b)(2). There's a couple of sections in it. These are the most important ones and the ones which are examinable. Section 10(b)(2)(a) says, if the shareholder, so if I'm the person receiving this foreign dividend, if I have 10% or more of the shares in that foreign company, so if I own 10%, 11%, 12%, 50%, whatever percentage, 10% or more, then it's 100% exempt. So if you have higher percentage shareholding, it's exempt. Now the reason for this is because there are sections in the Act that gives you special rules about how you should be taxed on the income of a foreign company if you own 10% or more. Most of that is no longer in your syllabus, but just understand that this is the exemption around that. Then section 10b(2)(d) and E says, if that foreign company is also listed in South Africa, or is listed in South Africa, then it's also 100% exempt. Now, remember, companies can list on share exchanges or in different companies. So you can have a South African company, for example, that is listed on a German stock exchange. You can have a company in the UK that is listed on South Africa's stock exchange. Remember, that is possible to do as long as you meet the requirements of the stock exchanges. So they will tell you, this is a foreign company, and this company is listed on the JSE. Right, then it's listed in South Africa, then it's 100% exempt. If section 10b(2) does not apply, then you will apply this exemption, which I've said is X over Y. Specifically, I've mentioned it like that because this can change. Now, what I want you to understand is that you need to see that it is this fraction that you apply is different if you're a natural person, a trust, or a deceased estate, or if you're a company. So natural persons and companies have different ones. And then just over here, one comment. Please note that if you receive a foreign dividend in the form of an annuity, it is not exempt at all under section 10b, so it's taxed in full. They'll have to also again tell you this foreign dividend was received as an annuity. Okay, so very simple. Now, my comment about this rate changes. Again, because you are starting to be a professional and someone who is going to work in a tax environment where rates changes every year or every couple of years, you need to understand that those exemptions can change. So you need to be able to go and look at your legislation to understand what is the exemption that is applied. And because you're a student, you might have to look at what your university requires you to do. But I'm going to quickly explain to you how that fraction works. Okay, so how this works. Now basically what it says is it considers two things. It considers what is the tax rate for a company and what is the dividends tax rate. That's for a company, and for a natural person, they consider what is the tax rate, the highest tax rate that is applicable, so the highest tax bracket, and the dividends tax rate. So, let me explain. So, if the company, a South African company, has a 28% tax rate, and the dividends tax rate is 20%, then that fraction is calculated as follows. They'll say, what is the tax rate, 28, minus 20%, which is the dividends tax rate, gives you 8. So the fraction is then considered to be 8 over 28. If the company's tax rate changes to 27% and the dividends tax rate, let's just say, is still the same as 20%, then it's 7. So then it's 7 over 27. So this is important for if there are companies' tax rates. If this dividends tax rate had to change, for example, let's say the dividends tax rate became 15%, right, then it would be 13 over 28. Now, you don't need to do this calculation that I'm showing you here at all. Just go and look at your SAICA tax student handbook, your tax legislation. Just go and look at what it says there, or what your university requires. They'll tell you what it is. I'm just illustrating to you where it comes from. For a natural person, if the highest tax bracket, this doesn't mean that this is the tax bracket the individual is sitting in. You just look at what the highest tax bracket is. If it is 45% and the dividends tax rate is 20, so it gives you 25, then the fraction will be 25 over 45, for example. So I'm just pointing out to you the principle of how this works. You don't have to do these calculations. All I'm trying to show you and tell you here is that that fraction will change if tax rates changes. And you'll see if you go and read section 10b, it tells you that the minister, the Minister of Finance can basically change this as they want the rates. Okay, so do look also at your legislation for the applicable rates.